All right, everybody. We have my favorite guest of all time back in studio with us once again. The always outdressing, at least me and most everybody else, because you are a sharp-dressed man, Brian Johnson. Mr. BJ Brian Johnson from Valley Mortgage. So good morning, BJ.
Good morning, Eric. How are you?
I'm perfect. I think you always get a little bit nervous about the introduction and what I'm going to say.
I never know what you're going to say.
Yeah, I don't either. So that, you and I both get to be surprised when it comes out of my mouth. Hey, at the top of the hour, BJ, I know you were tuning in, and we're talking specifically about when somebody needs to sell in order to buy. What does that look like on your end, on the mortgage lending end?
Well, sellers get a little nervous because they're not sure how the process works. So we like to sit down with them, go over their options, kind of give them a roadmap on what they qualify for if they were to sell, maybe give them some financial advice, take a look at their credit on if they need to do anything to get ready to sell in order to buy the next house. So if there's some debts maybe they want to pay off with the proceeds from the sale of their house, or how much down payment they're going to need for the next house to kind of get their monthly payment where they want to be.
So if we take a look at this from a 10,000-foot view, let's say I own a $200,000 to $250,000 house. Let's say, because the average sales price right now in our market is $215,000. So let's say I own the average house in the Fargo-Moorhead area at $215,000. I've lived there for 8 to 9 years, which is about the average number of years that somebody lives in a house. Okay. What kind of equity would you expect me to have if I never refinanced and I put down the minimum amount when I first purchased?
I suppose it would depend on the area and the type of home, but maybe $50,000 to $60,000.
So we got some cash, right?
Typically.
Let's say now I find myself with a better job. My wife finds herself with a better job. And so now we're thinking, you know what? We want to move up. We want to buy a $400,000 home. We want to double the value. We want to get more amenities, more space, and a better neighborhood than what we're in, right?
Yep.
Common story that we see every day in this industry. If I sit down with you and you look at all our numbers and you find out that, you know what? I don't need to sell my house in order to buy a house. Should I take out and have two mortgages so I own my $215,000 house and purchase my $400,000 house?
More people are actually looking at doing that because they don't want to have to move and try to sell and move all in the same day. And that's a lot of stress on some families. So if they can qualify for both, and sometimes we can help them get maybe a bridge loan on their current home to take that equity to put towards the next house. That gives them the flexibility to go ahead and buy the next house, move in, and then look at selling their existing home. A lot of people maybe need to do some updates on their existing home or do some things to get it ready to sell. So that gives them that flexibility to do that.
Brian Johnson, what the heck is a bridge loan?
If you have a lot of...
I know. I know I'm a realtor,
know.
So I'm trying to just ask for the audience.
Sure, yeah.
But tell me too.
Most people probably have heard of it. It's kind of like a home equity loan on your existing property. So you take the equity that you have in your existing property.
The $50,000, if we go back to the example, right?
Right.
Okay.
Now there is a limit on how much you can borrow on that, up to a certain percentage of the value. So typically it's 80 to 90% of your home's current worth.
So 40 to 45,000 is what I could borrow based on the equity. If I have 50,000 in equity and you say 80 to 90%, I can take 40 to 45,000 of that.
Let's back up. It's 80 to 90% of the total value.
Oh.
And then you have to subtract out your current first mortgage or second mortgage, how many ever mortgages you have on it. And then the difference of that amount is what you could use to put down for down payment on the next house.
Okay. So these bridge loans have a lot of layers to them. Am I understanding that correctly?
They can, yes.
Okay.
If you have great credit and you've got some equity in your house, they're a lot easier to do.
Now, we live in one of the more conservative parts of the country, at least in how people spend fiscally and how they invest their dollars. Do we see, if we lived in Phoenix, Arizona, or Tampa, Florida, would bridge loans be more relevant and prevalent?
They would be a lot more difficult right now to do. Lending guidelines are loosening up quite a bit nationwide. They're getting back to normal. A lot of the stops that were put into place after the mortgage crisis, they're starting to loosen those up a little bit. But you have some of those bigger markets where they were hit pretty hard. They haven't loosened those up so much. So bridge loans in those types of markets are probably going to be a little bit more difficult to come by.
Now, I always say this, and this is one of my life mantras of a sort. I probably need more mantras. But Brian, what I say is just because you can doesn't mean that you should.
Right.
I think that this situation in terms of how to sell and buy in one fell swoop requires some conversation and not just listening to us on the radio for a few minutes and saying, well, now I know what to do, right?
Right. We take a look at everybody's situation, give them a couple options and say, okay, here's where you want to go. This is what you're looking to do. This is what you want to spend on a monthly basis. Here's what you need to do to get that. So we try to give people some options on what they can and cannot do when they look at moving and moving up.
Right. Now, one of my favorite things that happens in this industry is, let's say we go back to that example and you have a $215,000 house and you have your $50,000 or $60,000 in equity, and people say, well, I don't want to have a mortgage now that's an extra $500 or $600. Let's say your mortgage payment right now is $1,200 and you don't want to go to an $1,800 mortgage. That's a lot of cash, right?
Right.
But the thing that I love about what you do, Brian, is that you'll sit down with them and you'll say, well, let's take a look at your credit card debt, your car payments, your student loans, and every other looming debt that's hanging above you. Because oftentimes people may be paying $1,200 for their mortgage, but they're also paying another $1,000 for those other bills or more.
Yep.
Right?
We take a look at the full financial picture and offer some advice on maybe it would make sense to pay this off or pay that down or refinance the student loans into lower interest rates. So there's different options, and it's really, we try to curtail that to every individual customer. So,
and I see it happen all the time that somebody goes from their $215,000 house with a $1,200 mortgage and then $1,000 in other bills, and then they go to a $400,000 house. They're spending $1,800, and they've eliminated those other bills, right?
Yep, that happens more than you think.
So you get twice the house, and you make $400 more a month in your pocket.
Yep.
BJ, people should talk to you. How do they do so?
Absolutely. Give us a call at 701-461-8450 or visit us online at valleymortgageinc.com.
And you can always, of course, contact Valley Mortgage through getting in touch with us at Hatch Realty. So find out what that home is worth that you're living in at livefargomoorhead.com and stick around. We'll be back after the break. This is Real Estate Radio with Erik Hatch.